Okay, I think that we are live. Let me just
Fantastic.
I want to see the speakers. Yes, hello. Welcome to the Taxation.com webinar series. We have two great guests with us today. We have Mr. Darren Gleeman. Excuse me, I've got my intro with the cards here. Right. We have Mr. Darren Gleeman, who's the franchise architect, the financial architect behind the only way for cannabis companies to to operate tax free. That's going to be a very interesting conversation. He is the president. He's the managing
Managing
partner.
partner.
Sorry, at managing partner at MBO Ventures. And yeah, MBO Ventures. Sorry, and then we have Ron Silverstein, who's the president CEO of CFO of Bud's Place. He is a certified franchise executive, and recently hailed as the top franchise influencer in the space. So thank you very much to both of you for joining me today. Let's just jump right in. Darren, you want to give a quick introduction? Well, let's start with, because I think we all know what franchises are, but what's an ESOP? That's a really very interesting concept. We discussed it before. Explain to our audience, what is an ESOP, what's it about, and what's it about? Let's start with that.
Yeah. So very simply, an ESOP is just another way to sell your company. You can sell your firm to a private equity firm. You can sell your firm to a strategic buyer, or you could sell your firm to this thing called an ESOP, where the employees become, let's say, the owners of the company. So the question is, why would you want to sell to your employees this ESOP structure when you can sell to a private equity firm, or you could sell to a strategic buyer, right? Why? Well, the government really wants you to sell to your employees. They want to democratize capitalism amongst the working class, as they've been wanting people to do this now for a very long time, for over 50 years. And so what they need to do is they need to incentivize, like people that own franchises, for instance, they need to incentivize you to sell to the employees via this thing called an ESOP, as opposed to selling to like I said, a private equity firm or strategic buyer. So how do I incentivize you? I mean, the employees have no money, right? So in a sense, the IRS and the government becomes the backer of it by giving you a lot of tax incentives and tax subsidies. And when you put it all together, it makes a pretty good option for you. And one of the very large subsidies that they give you is this. If you sell your company to an ESOP, you sell 100% of it, the company itself runs completely income tax free forever. That's zero federal income tax and zero state income tax forever. So if your company is making, let's say, for instance, it has $10 million in the net income, right? Normally, 10 million net income, you have to pay, with 280E could be, $5, 6, $7 million in income tax. That completely goes away. You pay no income tax. And because of that reason, it makes it's something that can completely change your cash flow around for your company. Most companies, especially in the cannabis space, are squeezed because of cash flow and because of 280E. Hopefully, rescheduling will occur. Maybe we'll talk about that in a little bit. But right now, 280E is squeezing the cannabis industry. You sell to an ESOP, and that completely goes away. And there are other tax benefits we can get to down the line here, but that's pretty huge. Hey, I think Ray is here.
Yes, he is. I just let him in the room. I guess he's waiting to turn on his camera. Hey, Raymond, what's up? Welcome. I will introduce you in a moment as soon as you're up and ready. But yeah, please feel free. You're welcome to join us. Um, awesome. Well, Ron, I want to ask you about your franchising in cannabis. And how that works, what potential tax implications there might be for that, especially with your lounge space, if you want to speak about what space a little bit. And then I want to kind of ask you both a question, because what I kind of want to get into, would a franchise opportunity in cannabis be, can that kind of be an ESOP? And just kind of hear what your thoughts are on that. So please go right ahead.
Sure. Thanks for having me, Amari. Happy to be here. So we're a franchisor of social consumption lounges at Bud's Place. And, the way we see it, in franchising is it gives people an opportunity to purchase a franchise and become a business owner. When, with their background, they might have a background as an employee or something like that. And what a franchise system provides is training, is support, is a system that enables people to be successful as a business owner when they may not have otherwise, been able to be a business owner. It also, and we don't have any lounges of our own open yet, but franchising, a lot lets you be part of a brand and get a lot of things like buying power, customer loyalty, etc., things that help you be successful with a better chance of being successful when you're part of a franchise system than if you tried to open up a business on your own. And there's all kinds of stats out there related to that, showing that franchise businesses do have a better opportunity to be successful than somebody that was just opening their own business. One of the opportunities for us in the cannabis space and in the hospitality space with our lounge model is because we're a bring your own concept right now, where the customers bring their own cannabis or have it delivered to them, and we're not touching the plant or selling it to them inside of one of our lounges. 280E won't apply. So all the cash flow benefits that Darren was talking about related to ESOPs, with our model, our lounges will not be subject to Section 280E. So we can deduct all our expenses.
And how does that work?
How does what work?
You said that you can 280E doesn't apply. How does that work?
Yeah, because just the regular tax laws apply. Since we're not selling cannabis to the customer, we're not touching the plant.
That's awesome.
In our model, so we can have bank accounts, we can get bank loans, we can have a national payroll company work with us for payroll. So our model won't work in every state right now. It's dependent on the rules that, a state or municipality has for their consumption lounges, because some states, like Nevada, don't allow bring your own, and the lounge has to sell the cannabis to its customers. So that's a state right now that our model won't work in. If a dispensary owner wanted to open one of our lounges and didn't care about the taxes, we're open to looking at that. But for now, we're a bring your own model, at least until cannabis is federally legal or gets rescheduled. And then we'll have additional potential revenue streams if we want to sell cannabis in our lounges or allow franchisees to sell cannabis. Just like with alcohol, it's a potential future revenue stream. Right now, states that allow consumption lounges don't allow alcohol in a consumption lounge. They don't want cannabis and alcohol to be mixed for the customers. But that's really what our model is. We're a franchisor of consumption lounge. We have no competition out there right now. There's really nobody else out there that we're aware of that's franchising consumption lounges. And there are very few licensed consumption lounges that are open in the U.S. right now. So huge opportunity, a lot of great markets available, and we want to get this new industry launched in the right way.
Right on. Just a quick question about that, because you said if a dispensary owner wants to own a lounge, a Bud's Place, or to franchise a lounge, they may have to leave it 280. But what about if it's like a separate? If it's, say, right next door, it's like, well, we have this open space next to our dispensary, people can buy here and then go there. Is that permissible? I mean, how would that fall into that?
Yeah, so that's permissible in some of the states that allow consumption lounges right now. In Nevada, you still have to sell the cannabis in the lounge for the customers. So what we've seen in Nevada is lounges that have been open so far are part of dispensaries, or a big building that has a big dispensary in it, like at Planet 13 or at Nuwu, or the one that opened for a little while and then closed recently, Smoke and Mirrors. They were owned by dispensaries. They had the lounge inside the same building, and the customers would buy the cannabis from them and then had access to the lounge. And pretty much, the lounges that have been open so far, that's the model that they've been following. They've been little smoking rooms inside of a dispensary or attached to a dispensary. No food and beverage, no entertainment, no VIP rooms, no real reason for a customer to go there. No profit center. They were using them to sell more cannabis. They weren't building hospitality facilities, entertainment facilities. Food and beverage is important. So there's a lot of things that the initial lounges that opened up were missing. And that's one of the reasons, along with 280E and some of the tax rules, why they failed. So a new generation of lounges is starting to get going now. Bud's Place is part of that. Once we get our first one open, there's a lounge in Denver. There's a lounge in San Diego that have opened recently that are better models than the lounges that have been opened so far. And hopefully they'll do great and, give the customers a great experience and help this industry get going.
Right on, right on. All right, so yeah, let me ask the question: can a franchise be an ESOP? Is that possible? How would that work?
Yeah, I mean, there's no issue at all with that. A franchise is just a structure where someone is helping me manage the company. They're teaching me how to do it, and I can use their brands and I can use their whatever they're giving me. So a franchise, again, it's a great way to get into business, especially if I don't know what I'm doing. I'm using their knowledge to help me. It's kind of like having a C-suite that's there for me, right? And the relative fee for that brilliant C-suite of operators is pretty low. But in terms of the ESOP space, there's numerous, like McDonald's or Taco Bell's or Dunkin' Donuts, the franchisees that have sold their groups to ESOPs. Denny's done it, Supercuts has done it, and on the actual franchisor, meaning the company, a franchisor, which is what these guys are doing. A franchisor can also do it. Like there's one large company called AR Franchising and AR Homes, and it's a very large, it's a super huge luxury home building franchisor in the U.S. and they did it in 23. And I'm working with a very large company right now that's also a franchisor. So yeah, absolutely, totally can do it. Again, an ESOP is just a shareholder. That's it. An ESOP is just a shareholder.
Yeah. So Darren, when you're, the ESOP, you the ESOP is more of an exit strategy for the owner. Are they losing control? So if the franchisor or the franchisee group is owned 100% by one person, and it ends up, and they're exploring putting it into an ESOP, how much control do they have after they do that? So if they were the 100% owner and had total control, what happens once it goes into an ESOP?
So with an ESOP, you're using that inside of a corporation, right? And so it's inside of either a C Corp or an S Corp, regardless, it's a corporation. And so corporations aren't run by individuals. A corporation is governed by the board of directors. And so the board of directors will now govern the company. So just as before, if that individual was on the board of directors, maybe it's that person and their wife, they will continue to be on the board of directors. If it's them specifically, if it's one person on the board, that would be a fairly tiny board. But theoretically, yeah, that same board could govern the company that's 100% owned by an ESOP. Normally what happens with that is in the negotiations in the ESOP structure, it's not like a private equity that someone else is on the board. What will happen is the trustee who represents the employee will negotiate to have for that current board member, let's say it's you and you're the sole board member. What they'll do is they'll negotiate with you to have you put someone on the board that's an independent board member that you think would be better for the company. So now it would be two people on the board, you and this other individual that you chose. Most board of directors aren't one person. Most boards, have, 2, 3, 4, 5 people. And so when an ESOP structure comes in place, and if it's owned 100%, there's usually an additional board member that's put in place. So that's how that works. And then the management team would still be, Ron, let's say you're running the company, right? And you're managing that franchisee location. You would still continue to be running that franchisee location. That wouldn't change at all. And you would still be using the franchise group.
Okay. So in that case, the franchisee could then essentially have multiple ESOPs in various locations with each specific franchisee. Is that what you
No, I mean, if it's a franchisee, like for instance, some of these franchisees, like I was saying, let's say you have a McDonald's franchise. I mean, if you have one McDonald's store, you're not really big enough to do an ESOP. So, but the idea here is to buy a McDonald's. I don't want one unit. I'm not going to make enough money. So the idea to buy McDonald's, I want to start increasing my number. That's how I make my money, because you have this great franchisor for you. So if I have, let's say, 5, 10, 15, 20 McDonald's, then what I'm going to do is I'm going to sell the entire piece to the ESOP. And you don't have to sell 100%. A lot of times people will sell, a small piece. They may sell 30%. Because one of the other advantages when you sell to an ESOP, right, you can defer your capital gains tax. And if you structure it correctly, you can defer it forever. And a lot of the large franchisors also, there's certain rules on who you can and can't sell an ESOP, the company to. A lot of times you just can't sell it. But if you're going to sell it to your employees with ESOP structure, that's something that a lot of the franchisors think is okay.
How does that sound to you, Ron? What's your opinion on that?
Yeah, ESOPs can work in the right situation with the right seller, and the right buyer, and for the right reason. I've seen ESOPs being marketed lately to cannabis companies strictly as a way to get around 280E, and not talking about that it's really a change in ownership. I mean, you're selling the company. So if you're the owner, you're selling the company. Somebody else is now the owner, even though they hopefully, are on very friendly terms with you. When you're selling it to the employees, they're going to have certain rights. And, I guess, I'm not an expert in ESOPs. I'm far from it. So I'll defer to Darren on all that. But in my mind, you're losing control. You're giving up control. You can be voted out. Somebody else, potentially the 100% shareholder, not you. And while you can still be working there and helping manage the company, I think that you're not going to be in the same position after a sale to an ESOP as you were before, and it needs to be viewed first as an exit strategy for the owner, in my opinion. And it may come with a lot of benefits like no taxes and deferring gains and things like that. But the first thing with an ESOP is you're selling the company. So I think that's an important thing for everybody to look at as they're making their decision as to whether an ESOP makes sense for them. In my industry right now, the hospitality and the franchising of consumption lounges, everybody's really, just getting started on that. I hope I get into the position where we have a lot of units out there and a lot of franchisees, and people are looking at ESOPs and whether they can help. And the other thing is the ESOP thing and the cash flow in 280E. All that, could change in a year or two if cannabis gets legalized or rescheduled to where the cash flow is going to be there anyway. If 280E doesn't apply, because now you can deduct all your expenses and things like that. So, it's one of those, it could make sense for people right now, it could make sense for people into the future, but all that stuff could be changing, at any time if cannabis gets federally legalized. So, it can make sense for some people. I don't think it's something for everybody. The other thing to keep in mind is with private equity and strategic buyers, a lot of times they're coming in to buy your company with big growth plans. It's a different topic for a different day as to whether their growth plans end up working or not. But most private equity companies, when they're coming in to buy you, they're coming in to grow your business, to cut expenses, to do a lot of things to increase the value of the company in as short a period of time as possible. And it's not just the exit strategy. Then your exit strategy may be worth more because of what the potential buyers plan on doing with the company to grow it. So some of those buyers are coming in and buying your company for different reasons, and it gets to where you're comparing the value. Every buyer values a company differently, so it's really trying to get the best value for the company with whatever goals you may have, like sustaining the company and all that. There's different things to look at when for exit strategies. ESOPs are certainly one of them, but definitely not the only one to be considering.
All right,
Yeah,
right.
I mean,
Darren, you want to respond to that?
Yeah, I mean, that's what I deal with all the time. It's a lot of myths, but yeah, bottom line is, as I said in my first sentence, an ESOP is just another way to sell your company. And, Ron's great. If you're just starting out, unless you want to have like it as an acquisition tool, which it is, because I am private equity, I just can use an ESOP as a way to actually acquire firms, right? But yeah, he's absolutely correct in that is a way to exit, and you're exiting today at fair market value. That's the maximum that can be sold for. Fair market value is actually a legal standard that's never been codified. It's the price that a private equity firm would pay. So when a private equity firm comes in and acquires your company, maybe they're going to pay, let's just say $20 million EBITDA company, and the value is 20 million times $500 million. If the private equity firm can pay $100 million, the ESOP will pay $100 million too, and that's an exit. 100%, that's an exit. In terms of losing, having someone else run the company, well, no, there's no one else running the company. The company is not owned by the employees. The company is owned what's called by an employee stock ownership trust. Okay, so there's one owner, the employee stock ownership trust, and the employees are beneficiaries of that trust. And so there's a trustee that represents that trust, but the trustee does not have a seat on the board. And the board of directors, as I said earlier, is the one who's actually governing the company. So if you sell the company today and then the next day it's owned by the ESOP, again, it's not really changing in terms of the structure. Again, the board is governing it. It's not a company owned by one person. And in terms of the management, you are continuing to manage. No one's firing you. The board, in the way it works in a corporation, is the board is the one that actually fires or hires actually the C-suite team. So yeah, the board could fire you, but you're still on the board. So it's fairly unlikely. In terms of, is the private equity better? Yeah. I mean, if you see a private equity firm that you think is going to take your firm and do great for the employees and do great for you and build this thing out, then fantastic. It's just normally, if you take an ESOP structure versus private equity, look at the data, ESOP firms will definitely outlast private equity firms, ESOP owned. And one of the big reasons, number one, is you're doubling the cash flow. Forgetting about 280E. If I owned your firm, right, if I had a franchise of, let's say, in your Bud's world, and I owned it, and let's say I'm killing it, and I'm making $10 million a year. Well, if it's 100% owned by the employee and by the trust, forgetting about 280E, because you said it doesn't exist, you still have to pay $5 million in taxes. I don't. Right? So if you're owned by an ESOP, you pay no taxes. So your cash flow is double. Now, if you take that cash flow is doubling over the next 5 years, unless you have some brilliant, genius, amazing private equity operating partners that somehow are going to be so much better than me and my management team because of some plan that they have, then that would be great. But I mean, that's just like a coin toss. I don't think that that's true. I don't think a private equity firm that knows nothing about cannabis, for instance, can come in and actually do a better job than the current management team. And so in terms of ESOPs, we've structured every cannabis ESOP in the nation to date. And when they actually go to sell, they understand these are not dumb people. They understand they're actually selling it, and they get paid, fair market value for it. And then one thing they get is they get something called warrants, right? So when they sell today, right, they sell today for, again, let's use that example for 20 million EBITDA, sell for 100 million bucks. They're also going to get warrants that enables them to buy back a chunk of stock in their company at a very low rate into the future. So they still have a second bite at the apple along with the employees. So they're selling today. They're now running the firm completely tax-free. When they sell it, they don't pay their capital gains tax. They can defer the capital gains tax. And now, let's say it's 10 years down the road, and they built it up. Now, upon federal legalization, they want to sell to a strategic buyer. That's great, because no one can beat a strategic buyer. And I always suggest, if the strategic buyer wants to come in, give you all cash, great. But at that time, when the strategic buyer comes in, you have these warrants. So you're also, you're running along with the employees. So everyone does pretty well with it. So I think it's a pretty good option. But again, it is just an option. In terms of, there's always a lot of myths going on, with ESOPs. And it's part of what I do is you have to combat it all the time. It's kind of like me saying, oh, I know about franchises, kind of. And I heard that the franchisor can come in and buy out the franchisee at, below market rates anytime they want, which is not true. I'm just saying, it's when you don't really know what it is, there's always a lot of people going on and saying myths. And these myths get perpetuated over, time and again.
Yeah, son, and that's, I think, why we're here on the show, to try to dispel as many myths as we can, so all the people listening in, or that are going to watch it afterwards, we're helping them in their decision making by giving them better information than they might see out there otherwise.
Right.
Right on. And thank you guys for that as well. Let me take this opportunity to welcome Raymond Guns. He's the CRO at Dope CFO. Welcome, Raymond. Hi, how are you doing, man?
Hey, everybody. Glad to be here. Sorry for running late. Yeah, this has been an interesting conversation, just kind of hearing about the ESOPs and the franchise. And the industry is still changing and still growing. And it is kind of funny, Darren. Like, I just like hearing you talk about ESOPs, because I feel like I learn a little bit more every time, because it does, like, it makes sense, especially because it comes from outside of the cannabis industry. Like, it's not like we invented ESOPs for the cannabis industry. Like, it's been used before for tax strategy. Same with franchising. But yeah, I'm happy to be here. Kind of just quick question though, Darren. Kind of like, what companies would you see in the cannabis space? Just knowing that most cannabis companies are not $100 million companies, at least in my experience, they're usually sub 50 million in top line sales. Yeah. What type of cannabis companies would you say are a good fit where, obviously they're profitable, so they have money to spend on this type of project. But what type of cannabis companies do you think would be a good fit for an ESOP? Because obviously everybody is trying to like combat 280E and find a tax strategy that works. So who's a good fit?
Yeah, I think the best fit.
Can I jump in real quick?
Yeah.
Do you mind? And anyone can take this. Can you guys please explain what 280E is? Because we are kind of banning about, because we kind of know what it is, but there's some people who may not exactly know what the implications of 280E.
Yeah, I can start with that.
Yeah, does anyone want to jump on that for me?
Yeah, it's a section of the Internal Revenue Code that deals with, in a nutshell, it says that if you're operating an illegal business, which is what cannabis is right now because it's federally illegal, you can't deduct any of your business expenses. So you have your revenues and you have cost of goods sold, and that's it. So in most cases, the operating expenses, rent, insurance, payroll, depreciation, and it's possible that some of those can be cost of goods sold, but many of your regular business expenses that if you weren't subject to Section 280E would be deductible on your tax return can't be deducted on a tax return. So you're losing the benefit of a lot of ordinary and necessary business expenses because you're operating a business that's federally illegal. And have to file your tax return and pay a lot of extra taxes over and above what you would have paid if you weren't subject to Section 280E. So a big struggle in cannabis has been figuring out how to operate within the rules and get as many expenses into cost of goods sold as possible so that you reduce your federal income tax burden. And if 280, so what happens is cannabis companies could actually be losing money in their operations, but paying a lot of federal income taxes because they can't deduct a bunch of expenses that are showing up in their financial statements. And if cannabis gets federally legalized, or potentially rescheduled, it's likely that 280E wouldn't apply anymore, and they'd be able to deduct their expenses. And by not having those big federal income tax burdens, they'd get more cash.
Okay, right on. Awesome. Thank you. Yeah, Darren, you can go ahead and answer the question if you want.
Yeah. So 280 is a killer. Hopefully, it will be rescheduled, and hopefully that will happen within a short amount of time. And to answer your question, it's an ESOP works for a company that is profitable. It works in the cannabis space. If the EBITDA, which is the fancy word for saying your net income before your taxes, if your net income is about the floor is about $2 to $2.5 million would be the floor, and 20 employees, and that's what makes the start of a good ESOP. And the reason being, really, to initiate it, it's an M&A deal. As Ron was saying, you're selling the company, and this is it's a large deal. So you're dealing with, multiple lawyers, multiple law firms. You're dealing with accounting firms. You're dealing with valuation firms. Dealing with investment banking firms. So it's a pretty big deal. So that's why and then you have an annual costs are actually pretty cheap. Because remember, you're saving so much money, 280E or not, you're saving so much money. So if the company is making, let's say $2 million a year, that's the floor, forgetting about 280E, a normal company making $2 million net income still has to pay income tax of maybe, for that, anywhere from, depending on what state you're in, anywhere from, let's say, $600,000 to, $1 million. So it's a lot of money. But when you structure as an ESOP, that does go away. But so your annual fees for that could be anywhere from, let's say, $50,000 a year. So you're still having these additional fees that you have. So yeah, that's why I like to say about $2.5 million really is the floor. 20 employees, low debt, and a company that's doing pretty well is always better. And if the company is growing as opposed to shrinking, if a company is not doing well, it's not going to be good for private equity. It's not going to be good for an ESOP. It's not good for anybody. You really need a healthy company for this. Good question.
Right on.
That makes sense.
No, go for it. Yeah, go ahead.
No, it is interesting. Like a minimum, 2.5 million EBITDA, because there's a lot of people getting into cannabis. The majority of the companies, just because it is a startup industry coming out of prohibition, they're just not really big old companies. And so, like in my experience, I would say it's even like less than 20 million. Like a lot of cannabis companies, top line sales, and there's some statistics out there that have been thrown around, but I use 80%, like an 80-20 rule. And so it's like most companies are doing less than 20 million, like top line sales. But to your point, they can still have that like 2.53 million floor, in which case it does make sense for a good chunk of cannabis companies. But definitely to your point, it's not like a cure all where it's going to make your business profitable. Like you still got to run a profitable business at the end of the day. But once they get solved that problem, there's still the problem of 280Es. So I kind of like the ESOP as a solution.
Ray, what do you see as the EBITDA profit margin that's like healthy? I know it goes state by state. Like the way I look at it, when I look at a cannabis firm and I'm looking at, in let's say the better states, the bad states being like California, Oklahoma, Michigan, Oregon, those states, when I say bad, a lot of price compression, a lot of competition. I think the margins in those states, EBITDA margin is down to like 15%, which, okay, that's pretty good. Where in the other states, like for instance, like Massachusetts, Illinois, I think the margins are like 25%. And so when I look at and I look at a lot of different companies, I feel like those are the levels that I'm looking at. Do you agree with that? or do you see something differently?
I mean, I don't disagree with it, but I definitely kind of think of it as, yeah, it's definitely a percentage base. And there's a lot of companies with 0% EBITDA or profit after tax as a percentage. And so, like what's a good one? I would say a positive one, because there are a lot of this. There, we just elephant in the room. There are a lot of companies that are just, regardless of 280E, like they're operating a cash negative business, like cash flow negative. And it's like, well, you don't even need to talk about taxes yet because you're still running a cash flow negative business.
And you know what? It's like in a venture capital world, right? If it's a venture capital world, I don't want to see any EBITDA margin, because if there's any EBITDA margin, that means there's a lot of money left on the table for marketing to hire people. So you'd expect it. I want you to grow. If you're doing 20 million and you have an EBITDA of 4 million, that's ridiculous. But in the real world, and I think a lot of these dispensaries are real world, they're trying to grow, and they're not throwing money back in for marketing expenses and CapEx. That's why I'm saying that the margins, I'm looking for that type of margin. But yeah, I mean, if a company is growing and you're at the beginning stages, year 1, year 2, I agree. I don't want to see anything unless they're just not great operators and you see the top line declining. I want to see that top line, increasing, and then I'm not worried about the EBITDA margin. But for the ESOP, you do need the EBITDA margin because it's a debt structured instrument.
And you have to value the company. So I feel like that's kind of like a unique aspect of the ESOP of like, yeah, to your point, it's like, well, you kind of want to be growing because then it makes it advantageous for the ownership group to actually go through with the whole process. And then, yeah, to your point, it's just the size of the company definitely is going to impact a lot of it. It's a wide spectrum in the cannabis industry where you have some companies fairly well capitalized, like some of them are even pubcos, all the way down to just very bootstrap startups. So it really depends.
Yeah. Here you, Ray.
All right, Raymond, let me ask you this since you just got in. Again, we're bringing these things up, rescheduling, descheduling. Of course, I'm a proponent for descheduling, but that might not be what's going to happen from all indicators. What do you think is going to happen? The president has made some comments recently about rescheduling. And what would the implication then be for 280E? And then I'll ask you guys to chime in as to what implications that would have for your businesses, Darren, as well as Ron. Yeah. All right. Good.
Okay. Yeah. As far as I know better than to say, I believe something's going to happen at the federal level or not. Like I've been thinking that since 2000. Yeah, like 15, I was in Colorado looking at these grows, like, okay, like this is already legal. There's like money behind this. Like this will be federally everywhere by 2020. And I was wrong. So in my opinion, like something will happen. And I just think of like, there's enough states that have adult use and medical cannabis programs where it's the nature of, how our government works is if enough states legalize, the federal government kind of has to do something. I think the easiest route for everybody to get a quick win and like get another catalyst event for the cannabis industry, which we definitely need, is just rescheduling to 3. It's like, all right, they don't need to kind of make any drastic changes. They just admit that there's medical value in cannabis, Schedule 1 to Schedule 3, 280E goes away, which frees up a lot of cash flow. Yeah, so then it's like, what will happen? So if they do at some point reschedule or deschedule, it's no longer Schedule 1, which then 280E goes away. So it frees up our cash flow like right away. So we get that free cash flow each month to pay back investors, do dividends, make other, payments and increase the value of the companies, which again is going to be like a catalyst event for more investment. And then realistically, there will be more states will then accelerate their medical programs and adult use programs. Like once the federal government announces there's medical value in cannabis, you'll get a lot of these states that don't have medical programs or have a very, very restricted medical program will probably loosen up and move forward. So that's kind of what's going to happen. Immediate free cash flow, more increase in capital, and then long-term, it'll also accelerate a lot of these other states to start their own state programs, because we really only have 24 states with adult use, where you can, like any adult can buy it. And adult use is really the big unlock. It's like getting each state to have a medical program is great, but it's still restrictive. And so adult use is really what we're going for. So we still have, 26 states within the United States that still need to open adult use and then also get it, materially operating. So that's kind of what I think will happen. But at the end of the day, I always just try to live in the present. And it's like, don't run a business that's only profitable if like a president makes a decision. It's just like stress you out and it stress your investors out. So just try to run a business that's profitable in the current political situation and with 280E still in place. And then if it goes away, it's just a cherry on top is kind of how we think through the cash flow side of that.
Well, let me, since you brought it up, because there's been a lot of, there's been a large debate about adult use, that medical kind of suffers when adult use comes into play. Do you think that will be a factor if we reschedule it to Schedule E, which kind of, again, since it does have medical value, it opens up research and all that good stuff? You think there might be a push more towards a medical pharmaceutical side of things? But then, of course, there's the adult. Yeah, there's that level of conflict. How do you think that's going to be?
Yeah, like the Trojan horse type thing. What I've seen is in California, now Germany is going through this right now. So we can just use Germany as an example because they're going through it right now. And so Germany, like, just legalized, they had a medical program, and now Germany just legalized an adult use program. But they also have telemedicine where people can kind of call the doctor and get prescribed, get a license, a medical card. Back in the day, we used to have medical cards for patients. And so it's just pretty easy to get a medical card. And like back in the day, like I was never around, but I remember living in Wisconsin and hearing like the California cannabis lore. And that's like 2009 time frame. It's like, oh, you can go to California. There'll be weed doctors there that'll give you your medical card next to the dispensary. So like every market kind of goes through it. And so my experience is like the more cannabis, the more money, the more research, the quality goes up, the products goes up. And so I think it's a good thing. And like plenty of people are getting medical cards just because they don't want to get in trouble for possessing cannabis. And so it kind of allows them to have cannabis on their person and not get in trouble. And so I don't really care if people get medical cards who don't really have a medical need. It's like they just don't want to get a possession ticket. I live in Wisconsin. We don't have any medical program. We have no adult use program. All the cops are very, very cool at this point, but they're still definitely, if they wanted to, they could give me a possession ticket for having like a personal amount of cannabis. And if I have too many ounces of cannabis, they could give me an intent to distribute. And so like, you definitely still need medical legalization just to kind of do away with all these like ridiculous prohibition laws. But like very quickly, adult use is what brings in the capital needed to actually like grow these companies into something meaningful. At least in the United States. We're kind of fairly far behind as far as like medical standards in a lot of our products. But it's just the nature of the industry. Like, yes, once you legalize it, there may be more standard compliance costs, which will incur the costs, and it'll like weed out businesses that can't afford those compliant costs. But that's capitalism. It's life. It's okay. Those companies' assets will get absorbed by another cannabis company, and then we'll just kind of keep it rolling. My biggest thing is just making sure more people have access to cannabis. And so every time a state opens up adult use or medical, more people get access to cannabis. Once every state goes from medical to adult use, like that inflection point, like Ohio and Minnesota just went through the last 2 years, more people get access to cannabis. So kind of just see it as a win-win, but I'm biased because I'm like an internal optimist. I have to be, but that's kind of my thoughts on it from just like being in a state where it's illegal, but totally all of our clients are in legal states. So like I see it in both sides.
So Ray, I'm based in Michigan and spent a lot of time in Florida also. And what we saw in Michigan with adult use was that the medical cards have gone down greatly, and that dispensaries that used to have 3/4 of their space devoted to medical sales now have 3/4 of their space devoted to adult use sales, and the medical's kind of a sideline now. The medical card issuance in Michigan has gone down dramatically, and I've seen people talking about rescheduling, and this is what I wanted to get your opinion on. With rescheduling, I've seen a lot of influential people in the cannabis industry against rescheduling because they think that the adult use market and adult use dispensaries will be negatively affected by that, and that it may be a lot more difficult. People may need a prescription to get their marijuana, a prescription from a medical doctor. What are your thoughts on that, on any potential harmful effects to the adult use market if cannabis gets rescheduled to Schedule 3 from Schedule 1?
I get the idea, kind of, yeah, right? Like if it has medical value, then maybe it should only go through the medical channels. I think with the way that why I'm not worried about it, because again, like, you know, we only serve the cannabis industry, so I hope it doesn't just go away overnight. Because the federal government, I kind of just think of things as layers. There's like the federal government, that's how we focus on taxes and capital, but then there's also the state and local governments, and that's where, you know, state and local governments have their own taxes, sometimes even worse than the federal government. Just look at the state of California. And so I kind of think of it as just like the federal government already says it's illegal, and the states have already said, we don't care, we're going to do what we want. And so I think the states that have already raised their hand and said, we don't care, we will do what we want, they're going to continue to not care and do what they want, even if the federal government says, oh, it's now Schedule 3, and federally, maybe that means that we need, you know, big pharma to be involved. I think the states will be like, that's okay if that's how you think federally. We're going to have a different state program. And so I think kind of just how the federal government says it's illegal, and we have states all, you know, every year going, that's okay, government, federal government, we're going to take it from here, and we don't care what you think, we're going to make it legal. The same thing is going to happen once rescheduling comes around. And I get there is like some arguments of like, yeah, maybe it'll hurt some people, but I think why the medical card numbers go down once adult use legalizes is because, like I said, the vast majority of card holders didn't actually need medical grade cannabis or medical grade cannabis products, which there's even an argument, like, what's really the difference between a medical grade vape cartridge and a adult use vape cartridge? Like,
Yeah.
there's like some pills and other things, but realistically, it's like medical products and rec products are pretty much just products.
I think
and until insurance pays for it, like, what are we talking about here? Like, insurance are the ones, if it's actually medical, then they should cover it. And that's kind of what's cool, because in the UK and Europe and other countries, they actually do think it's real medical, and thus the insurance companies have to cover it as a medical product. That's it. Layers, you know? That's my thought.
I guess it's just a big unknown. I think the bottom line is nobody out there knows what's going to happen. It's a big unknown. Anybody saying they know what's going to happen is, I'd kind of take anything they say with a grain of salt, because you know, the rules can change. I've seen people say it could be rescheduled, and that they might still have provisions in there through Congress that 280E applies. So nobody really knows what's going to happen, you know. Like
that's why it's like, let's just stay
Trump
positive.
said a few weeks ago, it's not a done deal until it's a done deal.
Right. And even once 280E goes away, you still got this whole big problem of running a business profitably, which still an issue.
Okay, yeah, sorry about that. I'm having a couple of technical glitches there. No, I just wanted Darren to jump in, because I imagine if rescheduling takes place, or descheduling, that doesn't change too much for an ESOP except for your sales pitch, I guess. What was your take on that?
I'm very much rooting for rescheduling. It helps significantly for us, because I think most of the players that we've spoken to, they now understand the benefits of the ESOP, and they want to do it rescheduling or not. For me, if it reschedules, the great thing here is not that it's going to make a difference in terms of the law, but the outlook of people's minds for the lenders will change. And I think there's going to be a lot more lenders coming into this space. Right now you have, let's say you have 3 or 4 very large credit funds that are, not huge credit funds, but they're the ones that lend to the industry. And so the interest rates are very, very high. And the reason being is there's not much competition. And there's not much competition because there aren't many banks that will actually lend to the cash flow of cannabis, because it's illegal. And so you're a money launderer. So there's not many banks that really want to do this, the larger banks. If it gets rescheduled, I think what will happen is, again, it changes the mindset, where people may say a lot of these other credit funds who are not lending in will now decide to lend into the space, because a lot of the issues are the limited partners in these credit funds. So a credit fund, what you have is you have let's say large family offices, and you have mostly institutions that come in, insurance companies, and you have large pension funds, and it's a no-no. They don't want their company where they're putting money into invest into cannabis or lend into cannabis. And I'm hoping, again, I'm a Pollyanna also. I'm hoping that when it gets rescheduled, that might change, and now you'll have another 10 firms that will jump in. We have a credit stack, a lending stack of about 120 lenders in the normal world that we work with. And I do know there are a bunch that if it gets rescheduled, they're going to rethink it. Not because now all of a sudden something has changed in terms of federal legalization. It's not. So that's why I'm really rooting for rescheduling. I think it's going to be enormous for my business. What do I think is going to happen? I don't know. I think he might, based on what Trump said a couple of weeks ago, he's like, well, I think it's really good medically. He said that. He's like, but I'm not really sure it's good for, recreationally. So I think he might weirdly move to Schedule 2. And I guess I'm in the very, very small minority of people that even think that. But if he goes Schedule 2, that means he's moved the needle a little bit. He hasn't affected 280E, but he's still telling the country, all right, we're going to go away and saying there is some type of benefit here because I'm moving it to Schedule 2. So, it's still the high potential for abuse, but there is an accepted medical use with Schedule 2, where Schedule 1 there's not. So I think he might go Schedule 2. I mean, again, it's just a wide guess.
Anyone
A
else
weird
want to chime
guess.
in?
I haven't thought of that, but it very well could happen. And Darren did hit on some key points of whether it goes Schedule 2 or Schedule 3. It's a massive signal at the federal level that it's no longer just federally illegal. In which case there will be a lot more lenders entering the space because there's more people who look at the cannabis industry than people who actually serve the cannabis industry. And that's kind of what I've learned as well, speaking with a lot of CPAs and CPA firms that don't touch cannabis because our CPA licenses are, they're federally recognized licenses at the national level. And so it's still kind of people are afraid of it. And so getting that rescheduling to 2 or 3 will kind of lead to a lot more people entering the space because it does kind of relax a lot of stuff. But at the end of the day, it's just no one knows what's going to happen or when. No progress is perfect. And so I don't think keeping things the same is the answer. Even if he does do Schedule 2, as frustrating as that would be, it's still progress, which to me is a win. So I think that's kind of what people need to keep in mind of there's not going to be any perfect solution. Cannabis should have never been made illegal in the first place, but here we are. And so it's just just got to, play the game with where the game is at. And so I think that was a good point though, talking about the lenders and other people who will enter the space with any amount of federal movement of moving the needle will definitely be a signal for a lot of companies that it's a little bit more okay to come serve this industry and lend to this industry, which is really needed.
Yeah, and on the flip side, it'll help, I think, get more, whether this is good or bad, who knows? But I think if it moves a little bit federally, it'll open it up for more public companies to get involved in cannabis because a lot of U.S. public companies have stayed away because it's federally illegal. Some have made investments in other cannabis companies, but for the most part, they've stayed away because it's federally illegal. So that could help. It also brings back into play, the thing you started with, Raymond, or that you've talked about a few times today on this, is that it's important to run a company the right way and be profitable, have a profitable, well-run operating business in the cannabis space because lenders coming in, what we're seeing right now is a lot of the big cannabis companies that had borrowed a lot of money are defaulting on their loans. So we could have more lenders willing to lend, and then it's really, you need to have a good company that can show it can repay its loans. One of the basics in lending, is creditworthiness. So there's a lot of big companies right now running into debt maturities and being unable to repay their debt. So it's going to make it very important, as it should always be, to have a profitable company that's cash flowing, that if you're going to incur debt, you're going to, need to show that you can pay it back.
Yeah. That's always the elephant in the room. And I've talked with a few, lenders and people on the capital side in cannabis, and it's a lot of people used to talk about how much capital they raised for the cannabis space, and what companies they bought or merged into their portfolio. But it's we're all as those companies are not hitting their numbers and not hitting profitability, these claims to fame are becoming not that valuable anymore. And they're almost, I would argue, kind of becoming a black eye of oh, wait, what company did you work with where you blew how much investor value and you didn't get much return on that? And so it's a very interesting time in the cannabis space where it's that, the tide is coming out and people are being left with their pants down, which is kind of funny. And I get it, because it's I feel I feel bad for some of these executives in C-suite that just get hammered on in the cannabis industry for all this time. But it just, the reality is what it is. And it's whether you're a pub co or a private co, I think they both are coming up to similar debt struggles. It's just the nature of the industry. And so that's why I just keep beating the drum of profits. It's well, we do a lot of things as CPAs and CFOs, but at the end of the day, if the business isn't profitable, your tax strategy doesn't really matter that much. If the business isn't profitable, good luck raising capital. And so a lot of companies have a footprint now and they have assets. And so now it is, I kind of think it's the expansion plans are kind of being put on the back burner, and companies are more focused on how do we get a profitable business to then take advantage of some type of federal reform. Because if it happens and you're not profitable, it's hard to take advantage of it. And so that's kind of why I've just been beating the drum of profits the last 18 months. And I'll probably do it for the next 18 months until something changes.
Right. Awesome. You guys just answered my last question there. I just wanted to back up a little bit, because I don't think that we discussed this. What are the tax implications for a franchise? Do franchise fees get taxed? How did the tax structure work for a franchise? Just real quick.
Yeah. So with a franchisor and franchisees. So franchisor is a little different than a franchisee. On the franchisor side, we have income. And a variety of sources of income. It could be franchise fees, it could be royalties, it could be marketing funds. The biggest source of funds are usually royalties. So we have income and we have expenses. And on the franchisor side, there's different rules on how to account for things, but all ordinary and necessary business expenses are deductible. It's just a matter of when you can deduct them. The franchisees operate the same way in our model. They'll have revenues from their customers. They'll have business expenses that they can deduct. They can depreciate fixed assets, and in most cases, write off a lot of the cost, if not all of the cost of the fixed assets in the first year. But it's normal tax rules for the most part for franchise businesses that are not selling cannabis. And there was a dispensary franchisor out there. There might be a couple now. I think one of the bigger ones went out of business, but they would have different rules if they're selling the cannabis, because then many of their operating expenses might not be deductible because of Section 280E. But for the most part, franchisors operate under the normal tax rules, other than there's a few special rules in how you record your franchise fee income and how you expense any commissions that you may have paid to franchise brokers.
Okay, great. Thank you. I think, we're coming up to the end of the hour right now. I think we'll wrap up at an hour. I think that's good. We had a great conversation. Any last statements, any comments that you want to make, any questions you want to ask in the room? And then also let people know how they can contact you guys as well if they want to get more information, please.
No final things. Appreciate you putting this on, Omari. Always find it interesting where the cannabis industry is going. And it's as it continues to change, it's good to have these conversations and bring a few perspectives together. So thanks for having me. And my name is out there on the internet, Dope CFO, Certified Advisor, Raymond Guns. You can find me in all the normal places.
Right on. Thank you, and thank you for coming in. It's always a pleasure having you, my friend. Always. Yeah. Isn't that Ron? You want to jump in?
Yeah, I'll take it. Thanks for having me, Amari. Good to see you again, Raymond, and good to meet you on here, Darren. Bud's Place, franchisor of social cannabis consumption lounges. We're out there on the internet. Our website is buds-place.com. My email address is rons@buds-place.com. We'd love to talk to anybody interested in lounges. We think we've got a great model. We need to get some open to help this industry get going. And there's huge upside. We think franchising is the way to go. We love franchising. I love franchising, and we think we've got a great model. And there's going to be a lot of good lounges out there, whether they're Bud's Places or whether they're under other brands. The lounge industry is the next big thing in cannabis, we think, and we're very happy to be a part of it.
One quick question. What about international franchising? Because I'm just thinking of a potential Caribbean, especially Jamaican audience. Are there any opportunities there?
There are opportunities there. We're not registered in any other countries right now. We don't have documents ready for other countries, but if somebody was interested in another country, we'd certainly check out on the legal side what we needed to do. Internationally, what usually happens with U.S. franchise brands is other countries love U.S. franchise brands. So our plans are right now to get it going in the U.S. and start building up a brand in the U.S. and then international expansion is possible for a lot of different cannabis businesses because the U.S. is changing every day in how it looks at cannabis and where you can purchase and consume cannabis, as are other countries. Like Raymond said, I was talking about Germany. So there's a lot of European, Asian, South American, Caribbean areas where cannabis is also very popular, becoming more accessible. And as it does, there's a need for lounges.
Yeah, right. Okay, Darren, let's end with you. Just any last words of advice for ESOP searchers, and again, how they can get in touch with you if they want more information.
Yeah, well, I want to thank everybody. I appreciate the opportunity to be on the panel with you. You can reach me. You can find me anywhere. I'm on the internet, Darren Gleeman, or my company, MBO Ventures. And ESOP, if you want to have a discussion, great. Email me if you figure it out, or get on LinkedIn and text me and talk about it. I think it's a good option for some companies. And
so who is the prime option? Is an ESOP the prime opportunity for? Who do you say is your target? Perfect.
In the cannabis space. For the cannabis space, the prime target is, any of these firms that have, net income is, it's growing. It's above $2.5 million per year. Low debt, those are that's the prime candidate. So prime candidate, the best candidate would be, 25 million in EBITDA plus. There's not that many of those, but that would be the prime candidate. I think dispensaries are great, manufacturing and cultivation, sometimes vertically integrated. So pretty much the entire spectrum is pretty good for ESOP.
Yeah. Okay. All right. Well, awesome. Great. Thank you guys all for joining me. This was a great conversation. I can see you guys individually for the podcast at some of the points in time because there's a lot. I can see a lot more depth that we can delve into each of the topics we covered today. So thank you guys very much, and let's keep in touch. Thank you very much.
Thanks, Amari.
Thanks, Amari.
All right. Take care.
Bye now.
Okay. Bye bye. Okay.